Federal Reserve has cut interest rates, and yet mortgage rates are up almost 1/4 point since Tuesday. So why is that? The Fed funds rate is what banks charge each other. It's short-term based. It directly affects things like credit card interest rates. However, mortgage rates are long-term, usually 15, 30 years. So that rate is set by the bonds market. It's directly tied to 7 or 10-year treasury prices. So I would look at it as the difference between today's weather versus the climate. The Fed funds rate is today's weather, whereas mortgage rates care about the long-term forecast, the climate. So when the Federal Reserve cuts interest rates like they did yesterday, your mortgage rates aren't necessarily going to go down. They might stay flat, and in this case, they went up because it's investor driven. What investors think is going to happen with things like inflation and the economy at large in the future matters more. In this case, what may have spooked investors and led to this uptick in mortgage rates during Jerome Powell's speech was he referenced the fact that so far inflation has been tempered because businesses are absorbing the additional costs due to tariffs, and kind of insinuating that in the future they will pass those costs on to consumers. The projection of future inflation is one of the biggest reasons that mortgage rates go up. So while the Fed funding rate definitely can have an impact on mortgage rates, it's not the same thing, and they don't always move in alignment.